Hi, so about 20% of the people who will watch this video will actually be completely new to my channel. So big welcome. I hope you enjoy my style of investing videos. And since you are new, this is what I'm looking for. So I want to look for a company that has a lot of growth with high rates of return. Companies that have a long runway in front of them. So it'll need to be probably a smallish cap company. And they also need to have great leadership with a high percentage of their net wealth tied up in the business. And if you know of a business that fits these three things, please share it with me. I'll even dig into it for you and give you some feedback. Please give me a rough elevator pitch though as well, because that'll help. Look, thanks for the ideas. Now to talk more, join my Discord group in the description where you can share the idea with me and we can chat about it in there. And specifically for today's video, I want to go through 4 companies that I'm working on to see if they do meet these criteria. Oh, and also in the description, you'll see a link to Interactive Brokers. That's the broker of choice for me to buy these investments. By far the best broker out there because it is reliable, has a great track record, and it's a public company itself, so we can see the balance sheet. Look, it isn't some startup like Robinhood or the craziness at FTX. Now let's go through the 4 companies that I am looking at right now. For those following my channel closely, this was on my list last time I did one of these videos, and it's here again today because I'm actually still thinking and working on it. So the issue I keep running into is that it's just not the most impressive of businesses. Gross margins are good, but running costs of a retail burrito shop are still really high, so net margins are slim. Plus, I think they have a flimsy balance sheet. If food prices rise further and there is consumer spending problems, then these guys are going to be in trouble. And they aren't being very conservative about this either. So they're aggressively expanding and taking the good retail spaces while there are good deals out there. Look, I like the expansion plan, but I don't like just the foundation of this business. Do I think they're going to be in trouble, or do I think they can pull this off? That's the question. There is big upside if they can get it right. Management seems capable and dedicated to grow this thing really big. That's a good sign. Plus, I like burritos. It's a really simple business. They have been doing really well even through the pandemic, not having to close any stores. So far, it's so good. But I just get uncomfortable that they can't handle a real recession. Look, I have no idea if that will happen, but some companies are fortresses and others are not. The obvious ones are like Berkshire Hathaway, Google, Apple, Markel, but even small cap companies can be fortresses too. And Tortilla Mexican is far from a fortress. It is trading at about 5, maybe 7 times EBITDA, so it's a very good price. I think they have a long runway to grow into. They have strong internal reinvestment rates by opening more stores and have a decent track record of doing that. I just need to get on board with management. And the issue is that the balance sheet that management is running is flimsy in my eyes. And it's not like they are the only cheap food option in London or England. It doesn't have a serious moat around them. They have no brand recognition. Maybe the locations they have secured are starting to be some sort of moat. That's something, but I just don't think that's going to hold up in a recession. So a solid business, but not special. I'm watching this one really closely. It's a simple business and I can understand it. Can it strengthen their balance sheet? Well, let's see, but they probably won't because they want to expand. But one thing keeping me interested is the simple fact that it could be huge. See, 500 stores throughout Europe is a real possibility, and that would be like a 20 or 40x from here in maybe about a decade. That would be epic. I'm still working on how asymmetric this bet is. Now, I found this on Value Investors Club, so check out the write-up over there. And thanks to my friend Ed Moyes for doing a lot of work on this one. Now, a big thanks to Partnership Investing on Twitter for uncovering this one. Follow him for a full write-up. This is right in my sweet spot, which is a serial acquirer. So for those who are interested in serial acquirers like me, a Norwegian company called CSAM is following the Constellation Software playbook. I've talked with the guys running the company and they are really good, smart people. They don't take themselves too seriously and they're working toward a dominant specialized health software conglomerate. It's a tiny business at the moment, less than $100 million US market cap. I think it's like 700 million Norwegian kroner, which is like 70 million USD. I really like that a large and growing part of this business is recurring revenues with government contracts. These are typically very sticky and really long-term in nature, and the churn rates are well below 2%, so that's really good. They are diversified across many niches, so this makes them, I think, really stable. Now, what I don't like about this business is that they're not profitable yet, and I don't like that they issue stock as part of new acquisitions. But being so small, this is what needs to be done. I get it. It's how a lot of serial acquirers have to get going. But structurally and philosophically, they are following the Constellation Software path. I'll have a bigger video on these guys sometime soon, but I just couldn't speak more highly of Sver and Einar, the CEO and CFO respectively at CSAM. Just great down-to-earth guys with a real focus and love for growing their business. It's the biggest reason I like this business. Okay, so this one might be a little out of left field, but I follow a YouTuber called Mario Skaznetsky from back in the oil tanker days. And this company I have done the least work on my list today, but I know Mario has done a huge amount. Now, Voxter Analytics is a real estate appraisal software business based in Canada. The core problem they are trying to solve is that there are a lot of fees and time involved in closing the sale of a house. Titles, appraisals, tax regulations, all that stuff. These things normally are added on by agents and done manually. It all sounds a little bit old school to me. And what Voxter are trying to do are bringing it a solution that's better, cheaper, like from a technology point of view, to speed this all up and get the costs far lower for the customer. Now, I think it's a clear win-win for most of the people involved. It appeals to me because it is a roll-up of software businesses to solve a pretty annoying and a pretty big problem. So how I see it really simply is that any complicated manual paperwork task that can be improved by software and save a lot of money for people, well, that is probably going to work. So regardless of whether a recession hits, people fundamentally will want to save money, and Voxter saves people time and money. But there's still a lot of questions on this one. For example, how competent are management? What is their integrity like? Are they long-term thinkers and building a solid foundation, or just trying to grow insanely fast like a tech company from Silicon Valley? So how profitable is the business without any of the reinvestment to grow? And what is the strategy to grow? Are they going to use debt? Are they going to issue more stock? So I had a little look around Twitter, and it looks like some unusual things were happening from the management. Not sure where my digging is going to lead. I probably should have a chat with the CEO or someone and see what I think from there. Anyway, just something to look into further if I have time. Maybe you've already done some research into this one and you can tell me more about it. So this one is courtesy of Investing with Tom. Check out his YouTube channel. I'm not exactly sure where he found this, but maybe through Frank from Lone Wolves Frank on Twitter. So definitely follow him, as he is one of the best small cap ideas guys out there. I appreciate these guys a lot and all the work that they do. Okay, so Hingham Institute for Savings is a small regional bank in the USA. Now, banks should be simple. They take in deposits and lend out money. Big banks just get really complicated really quickly with all the consulting and trading and M&A sections. Banks can just get crazy complicated, but HIFS is far easier to understand. They have a core business, and that is in commercial property lending, and that's their focus. Now, banks need to lend money out to make money, of course, so the obvious risk is how safe and good the returns are from those loans. If a lot of their loans go bad, well, that'll be the big risk for the bank. And for Hingham, they have really low bad debts, some of the lowest I've ever seen. And this is great because it takes a lot of the risk out of banks if they can be consistent like this and have their bad debts low. So even in the GFC in 2008, 2009, they had really low bad debts. So simply put, they are lending out money safely and making good money on those loans. Banks, like most businesses, are all about discipline. Now, I haven't got to the management part of this investment idea yet, but the surface level looks really good. A bank that is simple like Hingham isn't that hard to value. I look at price to book value and how book value has grown in the past. So book value for the past 10 years has grown at about 15% per annum. Therefore, I want to pay book value to get 15% per annum. Now, that assumes they can continue into the future, which I, of course, haven't got that far yet. Anyway, price to book value at Hingham doesn't get that low, and people pay a bit more for a good bank, up to even 2 times price to book. So I have a bit of juggling to do. I have to dig into management first anyway, so I have time, since price to book right now is about 1.6x. Maybe this is still a good price, so I need to do some more work on it. And Investing with Tom has some great videos on Hingham and banks in general if you want to wrap your head around banks. Okay, comments and ideas are greatly appreciated. Please don't just say, oh, what do you think about this stock? Give me the elevator pitch at least, please. Looking forward to the comments. Thanks for staying to the end, and I will see you next week.